right, so a few things that are going well on my risk radar, a few things that need an update. I've had the yellow for stocks since about the 14th of June. The idea was that equities had been getting very, very frothy in the AI trade. Everything else working pretty well here. I'm going to take them step by step. Stocks got to go green, though, because the futures now have been making highs for 2 days, and the melt up that I've been waiting for a while finally seems to have kicked in. And here's what's interesting is there was no rotation into the cyclical parts of the market. There was no adoption of small caps, mid caps, value, or breadth expanding generally. But because we've got strength from non-NVIDIA tech, it's worked pretty well without NVIDIA. So that's important. Firstly, is that NVIDIA has been basically still consolidating. And even though the yellow light maybe was too precautionary, it actually did catch the NVIDIA pullback pretty well, which is basically right here. So I put the yellow light on right before NVIDIA peaked out because the main concern was the market doesn't look like it has capacity to rotate away from the AI trade. But basically what it ended up doing was an intra-AI rotation, which has been Apple, which has been Meta, which has been now Tesla that woke up. So you're getting much more of a valuation-driven market, which I still think is a little bit more risky than what we had in the first quarter. But price is price, and you got the new highs, and so there you have it. S&P's cranking out more gains. That means you've got green light, and momentum is on your side until something breaks down. But here's the thing, is that the whole thesis that I had about why stocks were susceptible is because there's not enough economic strength or help from the Fed to allow for a more broad rotation in the market. And that has basically been correct. We still haven't seen a broader embrace. The equal weight is still going sideways. The small caps are still going sideways. The cyclicals are underperforming. And the bond market, where I've had the green light, did catch a really big bid here over the last few sessions. And so that makes me feel comfortable that that's the right way to view the bond market still, is that bulls are in control. If you look at the price for the bond, the ZN future, you can see we're still pretty much trending higher here. And this rally in bonds the last 3 days was really key. I pointed out earlier in the week that the sell-off in bonds didn't really make sense to me too much. And so to see bonds spring back and generally hold the trend of higher lows for price, of course, yield would look like this inverted. Lower yields. Still think that is generally the way we need to approach bonds because the data just keep missing. There is deterioration, there's no question about it. Is it a steep cliff that we're going to fall off? The evidence doesn't seem to point towards that. But the fact that the data were soft this week, namely the ISM services dropping below 50, but prices paid staying so high, wages also pretty sticky in the employment report. Even though unemployment's climbing, you still have inflationary forces while the economy's slowing down. That really is not the ideal outcome, and that's why the market still has been so concentrated in mega caps and tech. So a lot of the process that I used in putting that yellow light for stocks was correct, but the move in Apple, Tesla just has been mind-blowing, and it's pure valuation move. Tesla went from a 70 to 90 forward PE this week alone. Finally, the other important point, my red light on Bitcoin validated because the trend and the chart there is in a world of its own of bearishness. Bitcoin's in this long-term rolling top, it looks like, that's overpowering everything else in crypto, even while stocks are making highs. The correlation over the last 30 days between the NASDAQ and Bitcoin is some of the lowest we've ever seen. But this also speaks to why people are piling into the big tech names, because that's where the quality characteristics of the financial instruments are. They offer profits, they're gobbling up the earnings and the productivity and the growth around the world right now. That's how powerful they are. That's why the market's getting concentrated. And that's why Bitcoin and crypto is falling off and decoupling in a negative way, which is still very bad for crypto because it doesn't offer those things. So we are still in the hands of big tech. Mark Zuckerberg, ride that wakeboard. Have a great weekend.